Hello there. It's me, Stephen Thomas, with yet another housing debrief. And this time we're just going to really briefly go over housing and stagflation. It's one of those catchy titles that definitely gets a lot of clicks. But you know what? I just want to bring everybody up to speed because we are so data dependent that what we need to do is watch each data point. And this week had a data point that was extremely important to the Federal Reserve. And what's important to the Federal Reserve is important to everybody in economics as well as everybody in housing, because the Federal Reserve is going to orchestrate where interest rates are going to go into the future based upon their policy decisions. And this week we got a very huge data point, and that is called the Personal Consumption Expenditure, also known as PCE. This is similar to CPI, Consumer Price Index, and for some strange reason, maybe it has a catchier title, just about everybody cannot wait for CPI to come out. But if you're in economics land and you know that the Fed actually takes a harder look at PCE compared to CPI, you definitely are more concerned with PCE if you're in economics and you're a housing analyst like myself and the other housing analysts across the United States, the all five of us. But so we really follow the personal consumption expenditure very, very closely. CPI, not as much. And as a matter of fact, CPI is artificially higher because of their shelter component. Their shelter component's a big component of CPI, and they use something called owner's equivalent rent, which is just some obscure statistic, and it's a big giant chunk of CPI, and it's been vacillating as to what it normally does. So very, very hard to predict. Shelter components coming down slower anyways, and it's all about rents, not about residential resale. It's more about the rent side of the equation. That's the biggest piece of what's moving the inflation indices. But this is personal consumption expenditure, and this actually came out on Friday, April 26th. And you could see here those dots. This goes way back in time. Of course, this goes all the way back to the the late 1950s, right around 1960, and you could see where there was entrenched inflation of the 60s, 70s, and 80s, and you could see on the right hand side that is today's inflation, and it looks relatively tame. When you draw a line across, the last time we were at this level was in the 90s when we had another recession that was caused by the savings and loan scandals. So that was the last time that we were this high for the PCE. However, it is coming down, but you could see those dots under it says last 24 months, and the last three dots are January, February, March. Now, from February to March, if you go out many digits, it's actually continuing to go down as far as core is concerned. We're looking at the purple dots, not the aqua dots. The aqua dots sounds like some kiddie cartoon show, but the aqua dots, that is just headline inflation. And the Fed really can't control or they can't really persuade gasoline prices to go up or down based upon their policy. That's more of an international flair to it, as well as they can't really stop food prices from escalating out of control when you have like bird flu problems with the chickens and the eggs, and eggs all of a sudden spike. You can't really do anything with that with the policies. So they pull out the volatility of food and fuel, and that's what core is. And you can see core is coming down. It's coming down extremely slow. And we knew that that was going to be the case. Actually, we were hoping that it would come down a little bit faster, but you know what? Economics is slow and boring, and you got to look at the dots. You got to look at the trends, and the trends are showing that it's not going to come down really fast. And this is just personal consumption expenditure, also called PCE. This is a good education for you, and this is exactly what you should be looking at is this PCE, because it's extremely important. It's kind of like Jobs Week is extremely important. That's the first week of every month. Then PCE is important. There's a lot of important data points along the way, but as far as what is the most important, it's jobs, and looking at the initial unemployment claims on a weekly basis, as well as PCE and Then there's the other ones, but they don't hold as much weight as watching those couple of statistics. So I want everybody to know that where did they come up with this 2% target? Because right now we're at 2.8, and it's been stuck at 2.8, but now it's each time it's down a little bit more, so we'll get down to 2.7. Consensus was it was supposed to get down to 2.6, but in listening to the Fed, they already knew that it looked like it was going to be another 2.8% read. So that's why the markets didn't move that much based upon this. But I want everybody to know that they came up with the 2% target in 2012. So this was just an arbitrary number that 2% sounded good. It was started in European countries in the 1990s, and it was not made policy until January of 2012. So it's only 12 years old that we started saying 2%, that's where we want to be. Right now, it could be, they're saying that it could be closer to 2.5 or closer to 3%, and we're just bouncing around the 3%. So we don't really know, based upon the way that the current economic cycles are working, the way that countries are now starting to build their or produce their own goods, and they want to bring everything home, and we're not going to be as big of an international trading world population that we had been for so long, that everybody kind of wants to, like, they want good old USA, they want good old Great Britain products. They are still going to trade, but not at the rate that they were before. They're going to be building a lot and manufacturing more at home. So that's going to change where the rate is long term. We just don't know exactly where it is. It may not get to 2% anytime soon. The only way to really get towards 2% is if they kind of wreck the economy. And that could possibly be where they go if they continue to go down this pathway of trying to get down to 2%. So this last mile of getting down to 2% is going to absolutely be tough. And it is very, very sticky inflation. You can see how it's coming down, but it's coming down at a really, really slow rate. And something else that came out this past week is GDP. Now, GDP was supposed to be 2.5%, and instead we got a 1.6% reading, and everybody went crazy. Wall Street went nuts, and it wasn't the mere fact that the economy was slower than anticipated. It slowed down from the really, really fast velocity of the United States during the course of 2023. In 2024, it slowed down to 1.6% pace, which is still a solid pace, but it was a bigger slowdown than what everybody had originally anticipated. And the reason that markets actually reacted is because they're worried about something called stagflation. And what stagflation is when you have a slowing economy where it slows the point where it can be actually recessionary, unemployment rises, and the economy slows. At the same time, you have inflation going up. So even though you're in the midst of a recession and you need to reduce rates for the Federal Reserve, that's what they want to do to fight off a slowdown, they won't be able to when inflation's going up, because what they do to counter inflation is they jack up rates. So if they already have rates high, but now we have an inflation problem and the economy is slowing, they can't do much. It kind of boxes them into a corner, and that is what stagflation is. Now, my thinking actually in this, if you really want to know what an economist is thinking, is it's kind of, you could see that people are saying that inflation's rising, and they're just talking about the headline inflation with fuel, because at the gas pumps it's been a little bit more expensive, and there's a few other reasons why we've had headline inflation that has been higher lately. But you can see that core is doing fine. Not CPI's core, because CPI's core did something funky last month and went up slightly. But we're looking at PCE. It's a better index. It's what the Fed prefers, and it's what we prefer. So we're actually looking at that very closely. And it doesn't really show that inflation's getting out of hand or anything like that. Unlike this chart where inflation's going up and we've got the economy slowing down. It's Wall Street and financial markets doing what they do best, and that's called jumping to a conclusion and overthinking things, and the fear mongers come out, and it's the worst case scenario, and that's stagflation. So do I really think that that's what we're doing? No, inflation's kind of like flattened to 2.8% and slowly going down. So it's not anything where it's out of bounds inflation. That's for darn sure. And if you pull out the shelter index, so now it's food, fuel, and shelter, you're actually a little bit below that 2% target. So it's right where the Fed kind of wants to be. So it's still indicating that they're overly restrictive. And it's our viewpoint that the Fed should already be reducing the short-term rate, that we're not going to get inflation that goes out of control as a result of that. This inflation bout that we dealt with was more an absorption of two things. That was the federal government throwing a lot of stimulus money at consumers and the citizens across the United States and around the world, as well as having COVID-19 epidemic outbreak. So the combination of the two, and it was more COVID than anything else that disrupted so many supply chains and changed demand quite a bit, that is more of the culprit than anything else. And the further we get away from that, the more that markets are going to move towards a normalcy. But as we're seeing, it's a very, very slow pace, and the overall health of the economy is still really strong. Even at 1.6% growth, it is still growth nonetheless. And this is how the markets actually responded to everything. And I'm pointing right here to, that was the CPI release, and that was back in a couple of weeks ago. And then we got this release, and that was consumption. That was how much where retail sales were at, and retail sales were really, really high. So it too had a 10-year bounce. And the reason why I'm going over the 10-year Treasury is because it mirrors. There's a love affair between the 10-year Treasury as well as the 30-year mortgages. There's like this stickiness to the two. So you watch what happens when 10-year Treasury yields go up. The same thing happens with interest rates and mortgage-backed securities, and that's where interest rates are driven. So you can see here that is, so we had CPI, we had a hit, we had consumption, retail sales, that was a hit. It was too high compared to what expectations were. And then most recently, this was GDP. That was GDP just a few days ago. And then this is actually Friday when the PCE came out. And actually, after reading everything, and it came in at expectations, that actually it came down, and it didn't really illustrate that inflation is continuing to go up like so many outlets are talking about. Instead, you got to look at core, and core, when you go out to the decimal points, is still going down. So that's important to note. And that's why on Friday, we actually saw a retreat on 10-year treasuries. When it goes down, we have interest rates that go down as well. And where we're at right now, as far as rates are, when I draw a line across, we're right at towards the beginning of November was the last time we were this high on the 10-year Treasury. So similarly, like I said, 10-year Treasury, 10-year Treasury and interest rates, very, very similar. And you could see that this, I'm pointing to CPI increase, and then we're retail sales increase. And then this is GDP a few days ago. And then PCE on Friday, April 26th. So that is what's happened. It mirrored what happened with 10-year treasuries. Same thing happened. If I draw a line across, the last time we were here, I mean, we've been bouncing around this level of about 7.5%. But the last time we were here for duration was all the way towards the middle of November, not the beginning of November, like 10-year treasury. It closely mirrors each other, but they're not exact. So what this is saying is that still it's pointing to no rush for the Federal Reserve. And so the spring market is being met with a really high interest rate at 7.5%. We've talked about it before. We need to be at a 7% threshold in order below it for the markets to start churning again, for more sales to take place, for more buyers to participate, for more homeowners to place their homes on the market. Otherwise, it just gets too gummed up, too frozen of a marketplace. And that is kind of what we're dealing with right now when we're north of 7% with duration. And that is coming smack dab in the middle of the spring housing market. So we're very, very data dependent. Where April is already pretty much done. So I've done everybody a big giant favor, and I went to fxstreet.com and I toggled only the United States. Anything that has it really can move the markets, and that's in red. And then the moderate movement in markets as a response to the different data points. And I printed it all out, and this is what it looks like. You cannot see it. Even if I blew it up, you still wouldn't be able to see it. But what it outlines is the fact that there are a number of data points that will move the markets. Number one is going to be initial jobless claims and job openings. That comes out the first week of each month. Then we have CPI is a big one, retail sales is a big one, and then later on PCE, our favorite. So we're looking at the beginning of the month, jobs, end of the month, PCE. And then there's a lot of data points in between that will paint a different story. And that's why we get the gyrations in the marketplace. We got to watch it all. Why? Because that's what happens to housing. And if it continues to be sticky, we're going to be dealing with these higher interest rates for longer. But as soon as something breaks, because there's enough headwinds out there, we will start to see a softening in rates and then more movement when we get below 7%. And so if you like this content and what you're seeing, and we're trying to be brief, we're trying to educate, like it, subscribe to our channel, and go to reportsonhousing.com to see what all the different, we have free stuff as well there, as well a number of reports that you can sign up for. It's all Southern California counties. It's the Bay Area, as well as we have Phoenix and Vegas coming in May. So if you want a free month, utilize the coupon code STUCK, because right now we're kind of stuck. So I just want to thank you for joining us for another housing debrief. I hope you were educated, learned something, and we'll be continuing to bring you the latest and greatest, and we will see you on the